It's pretty easy to get deal flow. I'll be honest. Any conference I've gone to, I'll walk away with at least between 10 to 20 emerging fund managers that want to talk. It's a $20 million fund. We require a 7% stake, a 2% interest, allows me to have my principal paid back in 3.5 years. You can have a phenomenal business concept. You can have a phenomenal strategy. You can have a phenomenal idea and it just be the wrong time and you not be able to take root. When I talk about our investments, I got to think about my investors' money. I've got to think about my money that's in the fund, and I'm totally fine to put dollars into these projects, but I'm not going to purchase a stake in your business. I'll work with you for that. I see a lot of great pitches, and I'm a very logical person. I intentionally try to display some motion out of my analysis in a lot of ways. I've seen a lot of phenomenal pitches. Honestly, most conversations, if I just took the pitch at face value, I'd be like, hey, this is a decent investment opportunity. Really where the rubber hits the road is when I start digging. And that's what usually I'm optimistic about an opportunity until they give me a reason not to be. That's kind of the way I approach it. And I look for reasons not to be, mind you, right? Like I dig and I scour and I look for reasons not to. If they cite a number in their deck and I ask for where they source that from or how they're backing it up, or show me the financial model that got me that allowed you to say this number, and they don't provide that, like they're gone, right? Like they're out of there. I would say on most presentations, they're usually pretty good, but it's oftentimes, there's different types of investors, right? There's high net worths are very typically emotional investors. They honestly need to be sold on the asset class a lot of the time. They don't have exposure to real estate already, or they don't have exposure to venture already. And they need to be sold on why venture's good and why it's better than just the money you have with your financial advisor. When you're talking to maybe a person like myself or somebody that has an investments team, like I'm a very, very logical sale, right? Like I need to be sold logically on investing in the firm, and you need to demonstrate clear alpha. You need to demonstrate clear value prop, because look, at the end of the day, I look at 20 different decks a day. You have to give me a reason of why you're better than the person next to you. So those are things that I tend to look for. But I've certainly seen a lot of bad pitches in my time as well. I will interrupt people's presentations and ask them questions about how they're drawing that sort of conclusion. And was it a data-driven decision, or was it speculative? Was it your own data that you're citing? Was it somebody else's data? What's allowing you to draw that conclusion? So I think a lot of those things can come up even in the conversation as I just ask them about certain things on their pitch in follow-ups. If not there, then yeah, I usually, a materials request from these individuals. So I request their data room. Now, for example, a lot of these guys, if I look at emerging fund managers, I understand they're not going to have everything put together, right? They usually don't at the emerging manager level, but I need to verify like their deal history, right? And I need to verify that they've done transactions. I had a guy recently that pitched me. It was a great pitch, phenomenal presentation, cited historical experience of having about a $70 million portfolio of small businesses. And I said, that's phenomenal. That's great. I took it at face value on the call, right? As we go through, he talks about how he wants to build a fund around this structure. In follow-up diligence, as I said, look, you've clearly, at least you've claimed a good track record. Let's underwrite that. So I said, send me materials, show me proof, send me the financials of a few of these companies. Show me, I'm happy to sign an NDA, but show me proof of ownership of these assets. Gosh, he sent me over the biggest piece of trash model I've ever seen in my life. Honestly, I could have put it together my freshman year of high school, probably. Like it was that simple. And what does that tell me? It says run, right? Why? Like there's no way that you can successfully be running this business and not even know your numbers on your business. And if you are, you're probably doing something illegal, or I don't want to get involved with that. So there's things like that. There's a lot of different ways that you can underwrite people, and there's quick triggers in the underwriting process to, kind of sniff out those that are full BS. I have this matrix, but there's a guy I decided to partner with because I just loved. Did he have the most experience? No. Was he probably the best fund manager ever? Probably not. But did I think it was going to be extremely difficult to lose in his asset class? Yes. And so he had gone out and he went and he basically bought land and he put a parking lot on it, drew lines on it, and rented out spots for RV and boat storage, right? It's an uber simple business model. And he took down 4 of these assets and they were cash flowing like crazy. They were generating phenomenal returns. And I'm like, that is just a stupid, simple business that is going to be extremely difficult to lose in, right? I think I can help you. Like, while you may not be the best like fund manager caricature right now, right? He certainly didn't have the background for it. His ability to fundraise was okay, but it's like, I think it's going to be really difficult to lose in that scenario. I kind of weigh, these different variables as I'm doing my underwriting. I'm underwriting their probability of launch. I'm underwriting their time to launch. I'm underwriting their market, their industry. I'm underwriting their investment thesis, right? In addition to the ones I talked about previously. And so I feel like, and that's why we have this weighting matrix, because if you score really well in some parts, that doesn't mean it's a bad investment. I just think it's gonna require different focuses on my team, and I think that you can structure deals in a variety of ways to make a win for them, a win for us, and a win for our investors, right? So somebody that I have a really high confidence. So for example, for that individual, I didn't give them working capital, right? I wasn't willing to invest and purchase proceeds in that business just because I felt like there's a possibility that this business doesn't ever, really reach scale. But am I happy to invest in these types of projects? Absolutely. I think these projects are really sound, and I'm more than happy for you to go take down those. When I talk about our investments, I got to think about my investors' money. I've got to think about my money that's in the fund, and I'm totally fine to put dollars into these projects, but I'm not going to purchase a stake in your business. I'll work with you for that. For a different manager who had an extremely high ability to fundraise, he had already raised $30 million previously. He has extremely great networks. He had already soft circled about 8 million at the time of signing. I feel a lot more comfortable purchasing a stake in that business because there's contractual revenues coming in. For example, it's a venture fund, and I gave them $100K in working capital to get their business off the ground. But it's a $20 million fund. We acquired a 7% stake, a 2% interest, allows me to have my principal paid back in 3.5 years. Contractually. Over the course of the firm or the life of Fund 1, that's a 2.8x equity multiple on my working capital investment. Am I okay making that investment? Yes, absolutely. So I think that depending on the variable of risks and what the risks are at the investment at play, you can structure a deal that mitigates those risks, that mitigates downside while still allowing you to participate in upside. That's all investing really is at the end of the day, right? Is making asymmetrical investments where you're mitigating your downside exposure and increasing your upside return. Funds that win are investors that are able to make consistent returns on a risk-adjusted basis. That is the job of a fund manager. And we feel like we can do that, even though it's in an emerging fund that may be perceivably risky. We try to eliminate a lot of that risk out of the equation. For example, for that venture deal, right? Venture is perceived as extremely risky. We've, based on the contractual management fee income and our check that we wrote into their investment, let's assume that they perform in the bottom quartile of venture investments, meaning that they would generate about a 1.4 equity multiple over 10 years. So 4% IRR, we still produce a 9% return to our investors, right? And like that's, we are all about thinking about these worst case scenarios, and you can structure a deal to mitigate those. The worst pitch I've ever heard. I'm the type of guy that I value my time. I have cut off a number of individuals halfway through their presentation. I would say, look, it's obvious you haven't even practiced this before. You may have put together a presentation, but you've obviously never rehearsed this. How about we schedule this for a couple months down the road, or send me a recorded pitch once you have practiced? I have no problem saying that. And so I will, rather than endure a terrible pitch for 30 minutes or an hour, I will usually cut people off and I'll say, hey, thank you so much for your time. This has been great, but look, you obviously haven't prepared for this. It's obviously that they don't know their numbers. They don't know what they're talking about. They haven't put the time in on their end, and they expect me to put in the time for them. Look, I'm happy to guide emerging managers. I'm all about working with managers. Like, there was a manager we recently just passed on an investment committee for a few reasons. And I said, look, I'm happy to coach you for the next couple of months because I think he has the potential to be a really incredible fund manager. There's a few things that he's got going on that just don't get him quite across the finish line. But look, for somebody that is doing the work and that is having consistent progress and has momentum, I think momentum is probably one of the biggest drivers in business. And it's hard to stop a successful business that has momentum. It really is, regardless of their stage. So if you can always have the momentum, then I'm happy to work with those types of investors. So I said, look, so currently right now I'm coaching. I'm just, I set up calls with them every 3 weeks, just 30-minute sessions. And I'm like, look, I'm going to check in with you every 3 weeks for the next 3 months, right? At the end of this cycle, I think you could be ready. You just need to think through some of these stuff. And before my investment committee can sign off on making this investment, you have to mitigate these types of risks. And everything I've seen in underwriting so far demonstrates to me that he's the type of person that is going to do the work and is going to create momentum. And he just needs someone to guide him a little bit. When listening to managers pitch their funds or their products, most of the time it's because they've made it too complicated. They're trying to pursue maybe multiple investments. Like, they're like, hey, look, we're going to be doing these types of real estate investments over here, but we're also going to be doing these types of businesses. And it's just complicated. They'll try and integrate like a business along with their fund, right? Like, anytime I see something like that, I'm like, just stop, right? Like, I just want you to do this, right? Like, sure, if you have something on the side that is supporting you on deal flow, that's great. But, don't overcomplicate it, right? So I think anytime managers go that direction, I start to tune out. Anytime it's just too complicated when it's not designed for a fund, like a lot of times, like, you need to know what you're raising money for. Sometimes I'll get pitched on fund concepts and I'm like, dude, this isn't a fund. Like, you need venture dollars, right? You need to go pitch a venture capitalist to go raise money for your business idea. But I don't know why you're trying to do this through a fund. I think that's when I'll tune out like overly quick. That's probably some of the biggest things. We have a proprietary source of deal flow. We started a business about 4 years ago called Fund Launch. It's an education company, somewhat of a business incubator for emerging funds. And, we have a proprietary source of deal flow there. So we have, hundreds of emerging managers that come from that pipeline. But look, I mean, when there's not a lot of GP stakes investors that are willing to spend the time, the effort, and the dollars to support emerging fund managers, it's pretty easy to get deal flow. I'll be honest. I go to any conference I've gone to, I'll walk away with anywhere at least between 10 to 20 emerging fund managers that want to talk. Right? Like, because again, there's nobody that's providing this active advisory that's willing to put the time, effort, and capital into emerging fund managers. So deal flow is not an issue for us. We have an abundance of deal flow, both coming from internally that are just walking to us. I always like to have diverse sources of deal flow. And so I'm always trying to keep the pipeline full. I had taken a small stake advisory shares in a hedge fund. I mean, they were these two tech guys. They were phenomenal. I mean, great backgrounds, Silicon Valley experience, and just brilliant coders, if you will. They said, hey, look, we think we can build an algorithm that trades the market. And they did. And they had a really cool product, and they were going to start a hedge fund. I said, this is an AI. This is honestly before AI is what it is today. They had demonstrated a good track record, and they wanted to scale this business through a fund. After getting launched, one of the managers, they registered with the NFA. So there's a lot of different regulatory bodies that you have to register with. The SEC, FINRA, you have to get licensed, and depending on your industry, you might have additional regulatory oversight. And they were trading commodities and had to register as a commodity pool operator with the National Futures Association. They received an NFA audit weeks after getting launched. And the NFA is, oh gosh, I mean, they are brutal, right? They don't care about your business. They don't care. They care about their regulations being met. And so it's a brand new fund. They had I think 4 or 5 million under management. They were just kind of starting to get going, but they didn't have all their I's dotted and their T's crossed. I had just partnered with them, kind of, starting to piece together that material. And this audit was the end of them. It put so much stress on those two partners. They finally completed the audit and they said, I don't want to do this business anymore. Did I lose any money on that investment? No. I spent a lot of time working with them, but at the end of the day, we had to unwind that business. And so make sure you understand the industries that you're going to play in. I would say understand where you can add value, set proper expectations, and deliver on those expectations, and you're going to be all right. And I think the best way to learn anything is by doing it. I think that was a great lesson for me, and I'd encourage you to do the same. Basically, assume worst case scenarios and plan for that. It's what I'm getting at. So much of investing and business is timing, unfortunately. You can have a phenomenal business concept. You can have a phenomenal strategy. You can have a phenomenal idea and it just be the wrong time and you not be able to take root. I think you need to understand risks that are out of your control. Absolutely. And are you comfortable with those risks or outcomes? People who win in business know what their key variables are that dictate the outcome, and are able to either control or heavily influence those variables. And so as you're getting into funds or business, it's important to understand that time is not always a variable that you can control. Similar to that story I was telling you about a manager who's not ready. I mean, as I think about original mistake, I partnered with this firm it was way too early. He was a solo GP. He didn't have, his whole infrastructure together. I didn't purchase the stake because I knew it was early. I didn't even give him any capital originally, but I spent a lot of time working with that, right? Time becomes a very key metric as you start to do a bunch of deals and work with a bunch of businesses. And I had underestimated the amount of time that would take. And now today he's brought on like 3 other partners and he's finally got momentum on his business. But here we are, and it's like between when I partnered with him and when his business actually was able to piece together momentum was probably like 9 months, right? And so I would say that was a mistake. Again, I partnered too early, but it's a success at my cost, right? The question is, did I lose any investor money? No. Did I lose any of my money? No. But did I waste time of my own that I could have spent on other businesses? Absolutely. You know what I'm saying? So that was maybe a mistake that is now a success. And it really was, it wasn't a variable I could entirely control. It was just the wrong time.